What happens when the Fed cuts rates, but long-term rates on US debt continue to rise? Well, we're going to find out because that is exactly what is happening before our very eyes, and the results will not be pretty. This scenario could even push the Fed into resuming quantitative easing with major implications for gold, silver, and the US dollar. Today, we'll break down why the Fed might be forced into this position, what crisis could justify such a move, and why precious metals could be on the verge of an explosive rally. So, let's get to it. Did you know SD Bullion is giving away a monster box of 2024 Tree of Life silver coins? Sign up today at sdbullion.com/sweepstakes. Hey everybody, Smart Silver Stacker here. Hope you're doing well. So today we need to talk about the US debt crisis and specifically the rising interest rates on long-term US debt, because this is a real problem for the Treasury and for the Federal Reserve. Of course, you're aware likely that the Federal Reserve began cutting rates back at their September FOMC meeting. The Fed cut the federal funds rate by 50 basis points. And yet, if you look at a chart of the yield on a 30-year US Treasury, you can see that it has been steadily rising since that time. And I believe the interest rates on long-term US debt are rising for two reasons. The first is that the federal deficit has expanded to gargantuan proportions, multi-trillion-dollar deficits per year. And at this point, basically, the debt market has become saturated by all of the treasuries that have been sold into it. The treasury market is like any other market. There are supply-demand dynamics. From the perspective of the treasury, when you're selling all of this debt, you have to increase the yield in order to draw in buyers the more debt you sell. So, for example, if you're the treasury and you want to sell some 30-year US Treasuries, well, there's a certain pool of buyers who will buy those for 4%. But then once you've exhausted that pool, you've got to sweeten the pot to draw in additional investors. So you move it up to 4.1, and then that draws in a few more buyers or significant number of buyers. It doesn't matter. It's a finite number. And then if you want to sell more debt beyond that, you have to increase the yield even more. And that's what happens when the debt market becomes saturated. The more debt you sell, the higher the yield has to go. And also, there is the expectations of future inflation may be impacting these yields. So if you're an investor looking to buy government debt, you're not going to want to buy it for less than the rate of inflation. If you're going to buy a 30-year treasury that's, say, yielding 4%, if you expect the rate of inflation to be, say, 5% over the duration of that bond, that's not such a good deal. And so expectations of higher inflation among investors will cause investors to hold out for higher interest rates. That's why inflation puts upward pressure on bond yields. This is a real problem considering the fact that the interest cost of the US national debt is absolutely skyrocketing. It has risen just this past year to over $1 trillion annually, and the higher these long-term yields go, existing debt is going to get rolled over at the higher interest rate, and you're going to see the interest cost continue to rise until these yields are brought down, especially when you consider the fact that the government is continuing to borrow massive sums of fiat currency. Now, how can they react to this? Well, sure, they could rein in spending, right? Reduce the deficit, balance the budget. And I'm sorry, I have to chuckle when I pose that potential solution because I think we all know that that's not going to happen. You know, we got an election coming up, and it seems like one of the few things that both parties can agree on is that we need to continue borrowing huge sums of money. So it's not likely that they will do the right thing and rein in this debt crisis the right way. So what's the wrong way? What are they actually going to do? Well, like I mentioned, there are supply-demand dynamics in the bond market, and the more that you try to sell bonds, the higher the rates go. But on the flip side of that, the more buyers there are for bonds, then the lower rates will go. And who is the buyer and lender of last resort who can always drive the yields on these treasuries down? It's the Federal Reserve, and they do that through a process called quantitative easing, which is very simple. They basically create fiat currency out of nowhere and use it to buy this government debt. So they loan this newly created fiat currency to the government who spends it. It's very inflationary. And the Fed simply takes the debt onto their balance sheet And yeah, they pay lip service to the idea of perhaps normalizing their balance sheet at some point in the future. But if you look at the Fed balance sheet, you can see that it is still north of $7 trillion, despite the fact that they have been normalizing it for the past 2 years through a process called quantitative tightening. That's the opposite of quantitative easing. That's where the Fed actually sells or simply allows the bonds and debt on their balance sheet to mature. And the fact that ostensibly they are continuing with this program of quantitative tightening could also have a role to play in why yields are rising. So my forecast is that very soon the Federal Reserve will begin monetizing debt once again because there's really no choice. Otherwise, the interest cost on the national debt could spiral out of control. But it will be very difficult for them to do this in a vacuum because while investors and governments do actually love QE because they inflate these big asset bubbles, they tend to not like the inflation that comes along with them so much. And with a populace that now is more aware of currency debasement than ever before, despite the fact that they've been propagandized to believe that inflation is the result of anything but monetary policy and deficit spending, the Fed's going to need some kind of a cover here to justify more money printing. Now, what is that going to take the form of? Well, certainly just a broad economic recession could do the trick. You could see a credit market freeze like we had in 2008. Maybe it'll be some kind of geopolitical conflict, maybe a coordinated debt dump by our geopolitical opponents like China, for example, who control around $1 trillion worth of U.S. treasuries. That would be a good cover for them politically. They would say, well, if our enemies are going to sell the debt, then the Fed will just buy it up. You could also see a corporate debt crisis, possibly related to the commercial real estate market in the United States, which also is suffering under the effects of elevated interest rates. Could be banking sector stress. For example, remember back just last year in March of 2023 when we had banks failing, and now that was a result of the purchasing of low-yielding debt. The interest rates then began to rise, and as interest rates rise, existing debt that yields a lower interest rate, it loses value. And what we saw was a lot of these banks were loaded up to the gills with low-yielding U.S. debt that was bought up during previous episodes of Fed stimulus, which brought interest rates so low. And that's a good example of what actually comes of Fed intervention like QE. It just creates these asset bubbles and results in a lot of malinvestment, like on the part of those banks. But that's kind of an aside, a topic for another video. You could also see state or local governments experiencing financial stress because they don't have the luxury of printing money the way that the Fed and the federal government work together. So you might need to see interest rates brought down to alleviate some of that pressure. There could be a global economic slowdown, and they would say we need to stimulate the economy by printing a bunch of fiat currency. Somehow that's supposed to solve the problem. But if nothing else occurs, there's always the skyrocketing interest cost on the U.S. national debt, which is going to become a crisis in and of itself. Already, the interest cost on the national debt is the third largest item on the federal budget. And at the current trend, it's going to become the biggest expense very soon. The Fed has already returned to cutting interest rates. So it seems to me only a matter of time before they resume QE. But what is that going to mean for gold and silver? Well, think about this. Look at what the price of gold and silver have been doing over the past year. Both metals are up around, I think, 40%. I don't know the exact number, but that's throughout the Fed performing quantitative tightening. Imagine what will happen to the price of the precious metals when the Fed is forced to resume QE. They're going to absolutely explode. But I do want to throw a quick caveat in there regarding the outcome of the election. Just a few days ago, Donald Trump, it looked like, was heavily favored in the betting odds to win the U.S. presidential election this week, in just a couple of days here. Since that time, over the past several days, if you look at betting odds websites, and I like to look at these a lot more than any polls, because a betting market, people actually have skin in the game, so I just think it's not a perfect predictor or forecaster, but much better than polls whoever's conducting the poll probably has some kind of agenda. The odds have narrowed tremendously down to about a 50-50 split. I think Trump maintains a slight lead, but it's very, very close now, the betting odds. And at this point, it does seem to me like a Trump victory has been priced in. We saw a Bitcoin soaring to over $70,000 recently. on the anticipation of a Trump victory. If Trump wins, it likely would be very good for the stock market. Just look at what happened after his first election. Of course, a lot of that has to do with the fact that Donald Trump wants to pursue easy money policies. I think either way, the deficits are going to continue to rise. But what I do want to point out here is that there's a risk right now over the next couple days that if there's an upset, if Kamala manages to pull off this election and win, by hook or by crook, I mean, I'm not going to get into that, but if a Harris presidency is what's on the horizon, we could see a pretty significant sell-off in markets across the board because, well, having someone who's essentially a Marxist in the White House, I don't think the economy is going to like that very much. Now, ultimately, I do believe that under either president, the asset bubbles will be inflated. There will be huge amounts of money creation, but there's a real risk here that the Trump victory that has been priced in, if it's taken away from markets, you might see a very sharp short-term sell-off, and that might spread to the metals. Now, how low could they go? I have no idea. In a major market sell-off, the spot price, the paper price of gold and silver could go very low indeed. I don't know if you'd be able to get physical for those prices, but because of the looming issues with the debt crisis, I would remain incredibly bullish on the precious metals, regardless of the election outcome. And therefore, if we do see some kind of a sell-off in gold or silver on a Harris victory, I would view it as a huge buying opportunity. Now, this is not financial advice. I'm not telling anybody what to do, but I just want to point that out there that if you've been getting into stacking recently and you've been observing what's been happening with the precious metals, if you see some kind of a sharp sell-off in the next couple weeks, don't get disheartened. Don't be a weak hand. At least, I won't be. I'm not telling anybody what to do. It's not advice, but I think that some will be tempted to liquidate their positions in metals in the event that we get a sell-off, and I just want to point out that I will not be selling an ounce. But anyway, that's enough for this update. Thanks for watching, everybody. Let me know what you think about the topics that we covered in today's video down in the comments below, and I will catch you next time. Thanks for watching, everyone. Smart Silver Stacker, out.